You're listening to The Moose and the Loose, your 10 minutes action-packed financial podcast with your host, Mike Yahoo. Hey, what's up, Market Moose? Mike from The Moose on the Loose. Happy Thursday. So today we are closing in on my 5 most important investing rules. So on Monday, we talked about the dividend triangle. On Tuesday, we talked about the importance of having your thesis matching the dividend triangle or other financial metrics that you're following. On Wednesday, yesterday, we discussed about the only 3 reasons why I sell a stock. So when the investment thesis doesn't match my metric, and then I give a time frame. So of course, I don't go crazy after 2 quarters. I usually give like 2 to 3 years. I'm a patient man, patient investor, and usually it pays off very well. Rule number 2, sell on a dividend cut. This is where I am actually completely not patient, just selling upfront on the day of the news. Fortunately, didn't happen so often in my portfolio, but whenever it happens, pull out the plug and then move on. And the third one is about diversification. So 20% maximum in the sector, 10% for stocks. And I repeat, the 20% sector is a guideline. I will be comfortable going between 20 and 30% in a sector as long as the companies in that sectors do have different business models or invest or operate in different industries. So in other words, not just having one market event to completely destroy 30% of my portfolio. That's the goal. And the 10% for one stock is a hard rule where I do not want to be exposed more than that. Again, very personal rules. The point is not for you to mimic those rules, but actually to get some inspiration of, okay, so how should I build my portfolio? What are my buying rules? What are my selling rules? What are my overall rules around managing my portfolio so you get out of getting stuck by paralysis by analysis? Super important to take action, to grow your confidence, and to feel good about your portfolio. I mean, whatever happens on the market right now, the tariff, Trump's going after Canada, potentially recession in our country, whatever happens, I don't mind because I am confident in my portfolio and I know that the companies I have, most of them will find ways to adapt and to thrive. So today, 2 super important rules about portfolio management. The first one is when to look at your portfolio, and the next one is when to take action. So those are 2 super important things, right? Let's be honest, we all look at our portfolio all day, every day, right? I mean, it's just like we're passionate. We love to invest, and it's just fun to look at the stock market. And whenever you look at your stock market, well, you're tempted to look at how your portfolio is going. And this is how I got dozens of emails when a company like TFI International, like 2 weeks ago, dropped by 30% on earnings, or Stella Jones last fall dropped by more than 10% again. Got dozens of emails like, what's going on? Should I sell? It's the panic. And ironically, at the end of February, Stentec, one of my holding, has gone up by about 10%, and then the following day was also up on good earnings. You know how many emails I got? 0. Nothing. No one reached out to me to say, hey, Mike, what's going on with Stantec? I mean, it's booming. Why? Because it always hurt more to lose money than to make some. So now you can look at your portfolio every day. I'm guilty of doing that. Mostly more because I want to have a sense of what's going on the stock market. Not putting so much attention on individual stock. I just look at the portfolio value, and mostly it's related because I'm doing research pretty much every single day. So whenever I do research, I kind of look at my portfolio at the same time, right? But I never take actions. I don't really look at daily fluctuations, and most of the times, ironically, it's people telling me, oh, Mike, this company is going up 10%, going down 10%. I'm like, oh, really? Okay, what's going on? So here's the thing. When do I really look at my portfolio? When do I take time to take a good sense of what's going on? Once a quarter. 4 times a year, not more than that. What do I look? Well, I look at the earnings report. And fortunately, at Dividend Stocks Rock, I can just create my quarterly report review. where because we have like a team of analysts that are doing the summary of all companies' earnings every single quarter. So super easy for me. I just click on one button and then I have the summary of all the stocks that I have in my portfolio, so I can just look at what was important or not. So the most important question here is, what do I look for, right? Because I mean, saying, "Oh, I review quarterly earnings" sounds pretty cool, but you need to add a little bit more meat to that bone. So first thing, I will look at the dividend triangle numbers, so that are in the report. So revenue, earnings, dividend, the trend. So what happened this quarter? Is it like business as usual? Is there something different? So I have like a quick summary to tell me if there was something interesting in that quarter, or it was just a good or a bad quarter for whatever reason. So the first thing is to look at kind of like making sure that my investment thesis matches the metrics. So related to selling rule number one. So why do I have this company in my portfolio again? Okay, so what are they doing right now? Oh, they're doing the same thing. Great. So here's an example. This quarter, first quarter of 2025, CCL Industries reported a pretty good quarter. Actually reviewed it in one of the Moose on the Loose previously. Good quarter, good growth, revenues up, earnings up, dividend increase for the year. I think it was like 10%, all good. Do I spend a lot of time on this one? No. I mean, it was business as usual. Everything is going well. The comments are good. The dividend triangle is good. So my investment thesis is good. 2 minutes later, I'm already off to the next one. Here's an example of like companies that I will have a little bit more attention going forward. National Bank. For several quarters, it was just business as usual, super happy, didn't give much thought on it. But this specific quarter, 14% drop in net income for personal and commercial banking. That's like 50% of their business. Big increase in provision for credit losses. Actually, more than doubled this quarter. Wow. Okay, so that's a red flag. That's like something I don't like. A lot of positive out of this quarter, but this thing needs more monitoring. So I'm taking mental notes. I'm taking mental notes on stocks that are not doing that great, and this is how I review. So next quarter, I will follow that story for National Bank with a little bit more attention. So throughout the quarterly earnings, I will take mental notes on specific stocks and also on diversification. I will just look at the report, see the pie chart of the sectors, and say, okay, so I'm getting a little bit too exposed to this sector, or everything is fine, so I don't have to take too much time on this. And I always look at each of the holdings that I have in my portfolio with the dividend growth perspective in mind. Why? Because low yield, high dividend growth stocks will perform better, will be safer, will be less volatile than other type of stocks. If you don't believe me, you can download the Dividend Income for Life guide. I explained that in this guide. So you just go to moosemarkets.com/income. You put in your email, you download the Dividend Income for Life guide, and you will see how crazy it is that there's a big pattern between those companies with a strong dividend triangle, with a very interesting investment thesis, with a low yield and a high dividend growth profile. They do everything better than other dividend paying stocks. Crazy. So moosemarkets.com/income, Dividend Income for Life. So that's for my fourth rule. The last rule, kind of quite easy, but again, super important: when to take action. The number one rule here is to get out of paralysis by analysis. So ideally, I will take more time to review my entire portfolio and review those mental notes that I've done quarterly once a year. It's not perfect. Sometimes I will make more trades across the year depending on what's going on. You need to adapt, but most of the time I will do most of my trades pretty much around December, between December and February. Those are like the 3 months that I will like take time to reflect and take action. But the goal is, again, not to make a lot of trades. I rarely do more than selling 3 stocks than a year. Like most of the times, like 1 or 2, sometimes not even 1. Why? Because most of those companies, I've put the hard work in when I review those companies that I wrote my investment thesis, I reviewed the dividend triangle, and I have a high level of conviction. So once I did that, it's not like a couple of quarters that things are going sideways that will convince me to sell and move on quickly. I'm not afraid of like a temporary loss in my portfolio as long as I follow those rules. So that's the sum of all my mental notes that I will take reflection and say, okay, now it's time to take action. So the 10% rule is super easy. If I'm above 10%, I will trim like 2-3%, move on super fast. Dividend cut, that will happen across the year, again, super fast. And if everything's great, well, I just let my winners run and I don't give much thoughts about that. So this is how I take action on pretty much a yearly basis. And the goal, again, is to hold most of my companies for decades. And unfortunately, the economy is changing, the market environment changing, the company's business model changing, competition changing, everything is changing all the time. So you must review quarterly to ensure that you're still on track. If you are, no need to change anything. You don't have to fix something that is not broken, right? But if there is a problem somewhere, well, then it's time to take action. A good last trick that I want to give you before we end this podcast: I always keep a buy list handy. So always get excited about your next move. So it makes it so much easier to sell and then to buy something else when you already know where the proceeds of your sell is going to be. When you know what to buy, well, then you are looking forward to what you could sell in your portfolio to kind of improve it. Again, going back to that analogy where you have to constantly monitor rookies and making new drafts to build your team. Well, it's a lot easier to let go of an older player that is like struggling now to get someone new on board when you're already excited about this new recruit, right? So there you go. Those were my 5 most important investing rule number 1, focus on the dividend triangle. Rule number 2, making sure that you have a strong investment thesis, that you know what you own and why you own it, that matches financial metrics. Number 3 selling rules, super easy. When the investment thesis does not match the metrics, when there's a dividend cut, and for portfolio diversification purposes. Rule number 4, look at your portfolio quarterly. Take mental notes and leave it be. Rule number 5, take action roughly once a year and try to minimize as much as possible the number of trades. If you want to know more about my investment strategy, you can go to moosemarkets.com/income to download the Dividend Income for Life guide. It's all laid out there. You're going to even have an example of a retirement portfolio for young retirees. You're going to find that super interesting. So, all right, Moose, that's enough for today. Tomorrow, we are talking about pre-retirement investment strategy, how to build your cash reserve. So do not forget to like this podcast, give me that 5-star rating, and tomorrow morning, we're going to talk again. So do not forget to stay invested. Hey, welcome to the disclaimer. If you're listening to The Moose on the Loose, you cannot really expect me to give you buy or sell recommendation or financial advice, right? You're here for fun, you're here for information and some entertainment. But I am not your financial advisor, I am not your broker, so therefore I'm not liable if you're losing money after listening to the podcast. If you're looking for some advice, go see a professional. If not, you can enjoy this show and do your due diligence after it.